We will now talk about interest rates and security valuation. Various interest rate measures. These are definitions, vocabulary to be familiar with. The term interest rate can have many different meanings depending on the time frame used for analysis and the type of security being analyzed. For example, for bonds, the coupon rate, it's the interest rate paid by that bond. Now, not to be confused with the yield to maturity. This is the actual quoted percentage that you will receive from the face value of the bond. That is assuming that the bond has a coupon rate. Not all bonds make payments. Those are also known as zero coupon rate bonds. Required rate of return. Now, before I get into this, I want to, or I'd like to always clarify that many times in finance, people use the term required rate of return and expected rate of return as the same thing. And many times, depending on the context, that's fine because they're both an average of the return. However, they are different and it needs to be specified in much of the finance discussions and context. So required rate of return, it's what you as an investor required for a given risk. So if you're taking this amount of risk, you would require this amount of return. It doesn't mean you're going to get it. It just means what your requirement is, whether it's your preference, whether you're comparing to other opportunities. The point is that what is required to receive given that risk. If they don't meet that requirement, an investment, then maybe you shouldn't invest in it. But it has a lot to do with opportunities available as well. The expected rate of return, it's what that asset is expected to give. So if I have an asset of any given risk and I require 10% for that risk, but when you analyze the asset, the expectation is 12%, then it might be a good investment because it's expected to return more than what you require. It doesn't mean it's going to, but the expectation is there. If the expected rate of return is below that 10% that you require, you may reject that investment. So required is what you want based on that risk. Expected is what it is expected to happen in the future. Realized rate of return. This is after the fact. Now the time goes by. Let's say you did buy the asset, that 10 and 12% example in this case. The realized rate of return is what actually happened. Did you get your 10? Did you get the 12% that was expected? Now, let's say expected was 12, but the actual was 11. Well, sure, it didn't meet the expectation, but it still was more than your required return. So you're still in good hands, in good shape on the investment. Now, the realized rate of return was much lower, then it was not necessarily a bad investment, but it didn't meet the requirements and the expectation. Now, to continue talking about interest rate measures and how they impact markets and securities. So when a market is efficient, it means that the prices on the market of securities, whether stocks or bonds, reflect the fair price of its actual value. And if something changes, the price should change quickly, almost instantaneously. If that happens, the market is still efficient. Now, there's so many things that happen, not just interest rates. News come out, an event happens, just about anything that people react to the news, then what may happen is overreactions and underreactions, meaning that it can temporarily be off that fair present value or that fair price. So at any given time, it may move. However, the speed at which it adjusts back to its fair value is what make it efficient. The slower it adjusts, the less efficient the market is. The faster it adjusts, the more efficient the market is. So it's not an on and off switch. It's like a spectrum. There's degrees to this. Slow adjustments, lower efficiency. Fast adjustments, higher efficiency. An instantaneous adjustment will mean a market is efficient almost perfectly. So let's talk about bond valuation in this context. So bond valuation employs time value of money. No surprise there. This is finance, time value of money is everywhere. So by calculating the present value of a bond, which you can use your financial calculator, or you can use the present value calculation, manual one, represents whatever the fair price of that bond is at any given time in the present. The items that apply to value a bond is the maturity of the bond, the coupon rate of the bond, the future value of the bond, the yield to maturity of the bond, and then you use those numbers to calculate the present value of the bond. A few things that I'm going to mention here, and they will come later as well. When we talk about future value of a bond, it may say future value. It may also say face value, or it could also say par value. Those three mean the same: par value, face value, and future value. It's all the same. It's a future value. When we talk about the coupon rate is associated with the payment of the bond, never with the interest rate or yield to maturity. That's a different number. The reason I bring this up because coupon rate may be expressed as a percentage, and sometimes it's said as the interest paid by the bond, but it's not the total interest. That's just the payment portion. So therefore, that coupon rate is associated with the payment value, which you have to convert to a dollar amount. So when they say the coupon payment, that's already in dollars. You can use that. If it says coupon rate, it'll be a percentage. You have to convert it to that coupon payment, and that goes in your payment input in the calculation. The yield to maturity, that would be your actual total interest that you're earning, the total yield of the bond, which is roughly speaking, is the interest rate plus, or the coupon rate plus the capital gain. Therefore, that's separate or different from the coupon piece. Another way to say yield to maturity, you may see the term market rate. If you see the term market rate or similar assets are returning this or are yielding this, that's your yield to maturity. And that's how you sort out the data to calculate the present value of a bond. More on that with practical exercises. Now let's cover some more vocabulary on bonds. You're going to see terms like premium bond, discount bond, and par bond. What does this mean? Let's start with premium bond. In a nutshell, the most fundamental or basic explanation is, let's say a bond has a face value and or par value or future value. Remember, those three mean the same. Face value, future value, and par value, and it's $1,000. However, if you try to buy the bond, they're selling it for $1,150. So the price of the bond in this case is higher than the future value of the bond. We call that a premium bond. Why does this happen? This happens when the coupon rate, remember we talked about coupon rate versus yield to maturity, which is also known as market rate. So the coupon rate is higher or greater than the yield to maturity or the market rate of comparable assets in the market, is going to sell at a higher price. The logic is this bond, the coupon rate is paying a higher amount than other bonds similar to it, is yielding a higher price. So therefore they can sell it for a little more. I'm sorry, it's yielding a higher return. So therefore they can sell it for a little more. And that's what kind of balances out the market for them to be priced fairly. A discount bond is the opposite. You have a bond with a face value, future value, par value of $1,000, but when you buy it, or when you're going to buy it, it's selling for, let's say, $850. So it's selling for less than its future value. This happens when the coupon rate is lower than what other similar bonds are paying. Yield to maturity is higher, market rate is higher. So in order to make up that difference, they sell it for a lower price. That way it can bring up the total return on the bond. A par bond is when that coupon rate equals the yield to maturity or the market rate of other comparable assets. So therefore, par value bond or par bond is when the future value, let's say $1,000 in this example, equals the present value, $1,000. So you can buy for 1,000 and the future value is 1,000. And what you make, the money you make is through the coupon rate. This only happens when the coupon rate equals the yield to maturity or the market rate. Now let's go over some of equity valuation. So here's more like shares or stocks. Valuation process for an equity instrument, such as preferred or common stock, involves finding the present value of an infinite series of cash flows on the equity discounted at an appropriate interest rate. Okay. The point here to start with is the word infinite. And the reason is because a bond will have a maturity date. It's not a perpetuity. Stocks don't die unless the company go bankrupt. So the expectation is it will continue forever. So for example, if there's a dividend paying stock, it will continue forever. If it's a non-dividend paying stock, it will grow anyways. And so you have a capital gain. So while it says a series of cash flows, in the case of dividends, that's fine, but it doesn't necessarily have to be a cash flow for each evaluation. It could be the growth rate. We'll go more in detail on that later. First, they're going to talk about this cash flow from holding equity come from dividends paid out by the firm over the life of the stock. And they just give you typically the letters used for the formulas later. So right now we're talking about dividend paying stock. Now, here's the thing. We already mentioned that some stock pay dividends and some don't. So within the stocks that pay dividends, some pay the same amount every time. That means the dividend doesn't grow. The dividend stays at a fixed dollar amount. The way to calculate the present value of that, it's one way. This is more common with, let's say, preferred stock. It doesn't have to be, it's just an example. But in this case, let's say that every 3 months they pay $1 of dividends and the dollar stays the same. So that's what we call a constant dividend. Same dollar every time, forever. Then we have the one that the dividends may go up over time. So let's say the first dividend is $1, then the next dividend is $1.10, and that's a 10% increase, right? So it was a growth of 10%. Let's say it grows 10% again and 10% again. So here the dollar amount is changing, but the 10% stays the same. So the previous example where the dollar was the same, we call it constant dividend. That means the dollar amount is the same. But if we talk about constant growth dividend, we add the word growth here, means the percentage is the same. The dollar amount is going up by the same percentage. In that case, you will use the formula on the screen that you see now. So it's a different approach. In order to find how to calculate the constant dividend, that's a perpetuity, you can use the practical exercises as a simpler formula, but the constant growth is different, so the formula is slightly different. Now let's talk about, we're going to continue talking about the growth as a percentage. So in the previous example, the growth was the same percentage all the time. Now, what could happen is that every time they pay a dividend, it does grow, but not by the same percentage. That's where the term non-constant comes here. You may see terms like supernormal, super growth, and what happens is because many companies at the beginning, they grow really fast and then they stabilize and they go to a constant growth. But it doesn't have to be that way. So non-constant is the word I prefer because supernormal kind of implies that there's a larger percentage, but it doesn't have to be. It could be small, lower percentage first and higher later. It just depends. So non-constant is a better term to use. And the point is that now you have different growth rates. Here they explain to you kind of how you do it, and you add them at the end. You do two parts. You separate the two parts, and then you add them together. There will be exercises giving an example of this process. But at the end of the day is you got to separate it. The period where the percentages are not the same, and then the period where the percentage is the same forever. And then what you do a separate calculation of those two, and then at the end you add them together. And it's still a present value calculation. It's just like a two-stage or two steps. It could be three stages, it could be four stages, but typically the examples are two stages. But the point is, you'll have to separate the non-constant portion and then look for where it becomes constant and then calculate that piece. And then you just put them both together and that's it. So we mentioned that equity and stocks are assumed to go forever, or at least for a long time without any end in sight. It could be infinite as long as the company or the firm continues to operate. But back to the bonds, they do have a maturity date. And what happens is that as the interest rates in the market change, that price of the bond is changing with it. So one thing to be concerned about is that if I buy this bond, how sensitive this bond is to changes of those interest rates. How long can I count on this bond to still yield what I expect it to yield? Or that it maintains certain characteristics and qualities that fit in my investment portfolio according to my strategy. So in other words is, you buy the bond today, interest rates change, your bond value is going to change with it. So that's something to be concerned about. And it's one of the big players of how sensitive it is has to do with the maturity. How long is this bond before hitting maturity? So here we go. The impact of maturity on security values. A bond's price sensitivity is measured by the percentage change in its present value for a given change in the interest rate. So I got a bond of a certain price right now with a certain price. If the interest change, if an interest rate on the market changes by whatever amount, then how much is the price of my bond going to change? That's what they're saying. A few general rules of thumb is the shorter the time remaining to maturity, the closer a bond's price to its face value. So remember earlier we spoke about premium and discount bonds. What happens is that if you have a premium bond where the price is over $1,000 and a future value of 1,000, and the example earlier was 1,150, and the future was 1,000. As times goes by, that 1,150 is going to start going down. Assuming nothing else changes, is going to start going down until it meets 1,000. It's going to get closer to the face value. So, but that's assuming nothing else changes. The further the bond is from maturity, the more sensitive the price of a bond as interest rates change. So now we have this bond that the price is changing because time is going by. But then if interest, and that's assuming that there's no changes in the market with interest rates. But if interest rates also change, that bond price is also going to change, not just only because of the time that's going by, but because the conditions of the market have changed. And it can go in either direction. It can bring the price of the bond back up, or it can bring it down faster, even below the future value. So that's what we're going to talk about in the next few slides. In the same vein of premium bonds and discount bonds, you see here the term, the higher the bond's coupon rate, the higher its present value. Makes sense. The discount bond was a low coupon rate in comparison to the market, so the price was lower. As the coupon rate goes up, that price is going to keep on going up. And if it keeps on going up, if the coupon rate is actually higher than the yield to maturity, then the bond price. Now, let me say this specifically because the way I said it was to explain the changes in price. Coupon rates don't change. Those are already in the contract. What changes is the market rate. So if the market rate goes up, the price of your bond is going to go down because you cannot change the coupon rate. If the market rate starts going down, then the price of your bond starts going up. Remember this, the coupon rate does not change. That's already established. What changes is the market rate, and that changes the price of your bond. So that concern that the market rate changes over time and nobody controls that, well, the Fed can have an impact when they dictate the risk-free rate. Generally speaking, even if the Fed doesn't change anything, the market will fluctuate. So, and we're concerned about our bond prices changing because of that, because we cannot change the coupon rate, but the price changes. So now we talk about this term called duration. And by definition, duration is the weighted average time to maturity on an investment using the relative present values of the cash flows as weights. So it's a weighted average to maturity. And what it does, it produces an accurate measure of the price sensitivity of a bond to interest rate changes for relatively small changes in the interest rates. Now, so what it's saying is if the market rate changes in small percentages, there's small changes, then this duration calculation can give you a very accurate very accurate result on the calculation of what you're looking for. However, if there are big jumps in the market interest rates, this duration calculation becomes less accurate. Nevertheless, it doesn't mean you ignore it. You still use it and adjust accordingly. In addition to being a measure of the average life of an asset or liability, and by average life, understand because there's a maturity, they're also talking about, well, the average life in the sense of when I purchased it, it had this qualities, the life of those qualities. It's not like the bond goes away or dies. No, the life of those qualities of the bond may still hold within a parameter. That's what duration is doing. Now, get outside those parameters, the qualities of that bond change. So the life of those original qualities is done, but you still have the bond. You just got to work around that now. So the duration of a zero coupon bond. Now, earlier it was mentioned that not all bonds pay payments, make payments until you get to the future value. Those are called zero coupon bonds. You just get paid at the end. Now, for those bonds, to get this out of the way easy, the duration is equal to the present value. So this one's easy calculation. You calculate the present value of the bond. That's going to give you two things, the price of the bond, and also you can get the duration out of it. Now, here's when duration, I don't want to say complicated or the complex of duration, but it's not as easy as just a zero coupon bond where it's just present value and that's it. Now let's take consideration the higher the coupon or promised interest payments on the bond, the shorter its duration. The larger the coupon or promised interest payment, the more quickly investors receive cash flows on a bond, and the higher are the present value weights of those cash flows in the duration calculation. So this is what this means. Because the higher those payments you get earlier, you start recovering your investment sooner, so your risk has gone down. The same way that a long bond with a maturity so many years later, it takes longer to get your money, and there's a higher risk of things changing when you have shorter maturities and or larger payments. You're getting your money and you don't have that maturity risk either. So your risk is lower, is what they're saying. Now, duration and rate of return was the relationship. Duration decreases as the rate of the return of the bond increases. Pretty much saying the same about the coupon. But this also includes capital gains, etc. Duration and maturity. Duration increases with maturity, but at a decreasing rate. So it's not a straight line relationship. Now, you do a calculation, you get a number, but what does that mean economically? So, in addition to being a measure of the average life of a bond, duration is also a direct measure of its price sensitivity to changes in interest rates or elasticity. We are also interested in A, if the market rate changes this way or that way. That's why in the news, always talking about what the expected interest rate is going to be from the Fed, et cetera. That way you can prepare ahead is like the price of these bonds are going to change and it's going to change my whole strategy. It's going to have an impact on my investment strategy. Now, for small changes in interest rate, bond prices move in an inversely proportional manner based on the size of D. As we mentioned earlier, small changes, you get an more accurate resulting calculation. And here, where they're saying small changes are going to have a small change in price. But the inverse part is, remember, when interest rates go up in the market, the price goes down. When the interest rates in the market go down, bond prices go up. So that's inverse proportionality they're talking about. And here are the formulas. These will be practiced with exercises. So going back to what happens with large changes in interest rates, well, duration, as mentioned before, accurately measures the price sensitivity of financial securities, but only for small changes. As these changes become greater, the less accurate this calculation works. Luckily, in the United States at least, changes in interest rates happen slowly. Sometimes they speed up a little bit and get more aggressive if we have to control for inflation or trying to get out of a recession. However, under normal circumstances, changes of interest rates happen very, very slow and are very, very predictable. Duration misestimates the change in the value of a security following a large change. It could be up or down. It's just about a large change. So that brings in now this term convexity, which is the degree of curvature of the price interest rate curve around some interest rate level. So what we're saying is that when you have a small change in interest rate, convexity is less of an issue because you're only moving very small steps. But because large changes will expose the nonlinear relationship of this situation, now you have a convexity thing. So it, the changes are not only less predictable or the calculation duration is less accurate, but then you have to start picking and choosing where in that curve you are to see where might happen at that point. Now, it sounds like a bad thing, but it doesn't have to be. So convexity can be desirable. The greater the convexity of a security or portfolio of securities, the more insurance or interest rate protection an investor or financial institution manager has against rate increases and the greater potential it gains after interest rate falls. So if you have your securities, your portfolio securities set up in the proper way that a financial institution should have it, then convexity can work in your favor. Now, notice this is the financial institution side. Now, convexity increases the error and duration as an investment criterion. Going back to large changes in interest rate, convexity comes in play, so it increases the error on the calculation duration, which then, as I mentioned, the qualities of your bonds have changed, meaning that your investment criterion is not in the place where you wanted it to be when you first got those bonds. So the larger the interest rate changes and the more convex a fixed income security or portfolio, the greater the error in using just duration to immunize exposure to interest rate shocks. Okay, immunize is not a hedge, but think of it that way, which you can use these tools, these financial tools to protect other assets on changes. How to hedge, that's for different class and how that works. The point is that you may have these securities that you use them in order to diversify your portfolio to protect against changes, but then these large changes may had an impact on the qualities of these bonds, and now you're not as protected as you were when you first started. Now it's not the end of the world. You just have to adjust. Is it preferred? Not necessarily, because now you have transaction costs and just cost more work. So it exposes you. So in this case, convexity could be an issue. All fixed income securities are convex. So there's always convexity. The how bad or how severe the convexity is will vary from security to security. And also remember that this is more of a concern when it's a large change in interest rates. You can have a lot of convexity, but in a small change, you're not going to move up and down that convex. So that's it for this lecture. See you on the next one.